Hello, everyone, and welcome back to the 2018 Hack Summit. We're joined here today by Tammy Camp, the CEO of Stronghold, and Sean Bennett, who's the CTO and co-founder of Stronghold. And they're going to talk to us today about decentralized and distributed exchanges, as well as the regulatory concerns that go with them, as well as liquidity issues when it comes to market making. So, guys, it's a pleasure to have you here, and thanks so much for joining us.
Thanks for having us, Ed. And
You're
thanks
welcome.
for all of the attendees out there for joining us today.
Awesome. So why don't we go ahead and have you guys start off by introducing yourselves. Tell us a little bit more about your background, your prior work experience, and maybe a little bit about what you're building at Stronghold. So, Tammy, do you want to lead us off and start with that?
Sure. Yeah. So Stronghold is a next generation financial institution that is native to the blockchain. So what that means is that we kind of act like a normal financial institution, like a bank, and we allow people to deposit and withdraw funds from us, whether it be fiat currencies or other stores of value like Bitcoin, Ethereum, and soon probably stocks and bonds, and so forth. A little about my background is that I first learned about Bitcoin in 2011 when I was attending Singularity University at NASA Ames by a world-renowned cryptographer named Ralph Merkle.
And is this the Merkle proof?
Merkle? This is Merkle Tree Merkle. Yeah, talk to me about Bitcoin.
That's great. So maybe we should define this Merkle concept, because I'm not sure if everyone in the audience knows what that even means or has the content. Probably some of them do, but not all of them. Anyone want to jump in here and help explain that? I could try, by the way, if none of you guys want to do it.
Oh, you go for it. I'm just like the Merkle Tree Merkle, like Let Vitalik. Like, he does it the best.
All right, this is my terrible explanation for it. So it's basically, think of a binary tree in computer science, where the lowest level nodes in the binary tree are your data blocks, and the layer above that are leaf nodes, and the leaf nodes point to the data blocks, and then the interior nodes of this binary tree point to the leaf nodes, and they basically are one-way hashes of the data that's one level below that. So each layer of the tree is a hash of the layer beneath it, and at the very, very top is the root, which is called the Merkle root, which is the hash of everything below the tree, and that Merkle hash essentially is what gets stuck into a blockchain node, and it basically is used to determine all the data that was in there and that it hasn't been changed, because it's a hash that represents everything in that little tree. So Merkle was kind of the inventor of this, and this is used every day in the blockchain as an efficiency gain for the blockchain. So hopefully that clears it up for the audience. So Tammy, sorry for interrupting you there, but continue.
Yeah, that was very impressive, Ed. That was very impressive.
Oh, nice
job. And he also invented the public-private key pair as we know it today. Back in 1979, I think. So. Yeah. In any case, Ralph Merkle. After that, I started building Bitcoin, Litecoin, and Dogecoin miners 2013 out of computer components and programming them to mining pools. And then thereafter, I was the first head of growth at Stellar in 2014, where I was there during the time where they were doing the first airdrop, and we put 4 million users on the network in a little over 4 weeks. That's where I met my now co-founder, Sean. After Stellar, I was a partner at 500 Startups, where I would invest in startups at the seed stage, and also run their growth and marketing curriculum and all of their Silicon Valley accelerators called Marketing Hell Week. And then after that, I decided to start Stronghold with Sean.
That's an awesome story. Thank you for that. And Sean, you want to give us a little bit about your background?
Yeah, sure. So I came across Bitcoin in 2011 when it was being used as a donation method for WikiLeaks, right after the banking blockade and Visa and MasterCard stopped processing their transactions. I was actually at med school at the time. I thought, this is a really interesting thing I want to keep track of. But I didn't jump in fully until 2014 when Ripple and later Stellar came out, because I thought it was great to see real currency that everyday people knew. New Zealand dollars for me, right, or US dollars for a lot of attendees here. that I thought, okay, that's really where I'm going to jump in. So in 2014, I left all of that stuff behind and started building on top of Ripple and Stellar. So I was the first regulated business on top of Stellar back in the day doing US dollar on the chain, which of course is where I met Tammy. Post that, there wasn't so much interest back then, unfortunately, for this type of thing. Stable coins weren't quite so popular. So I stopped doing that and was a blockchain consultant for a couple of years in Australia. But now there's a lot more interest in crypto and teaming up with Tammy again now in the Stronghold.
Great, thank you guys. Okay, wonderful. So let's dive into kind of some of the challenges that you guys are trying to tackle at Stronghold. So let's start with market making. So maybe let's get the audience up to speed, just in case not all of them come from a financial background. So what is market making and how is that important? And how does that relate into what you're building at Stronghold?
So I guess one of the big problems for us, particularly where it comes to ICOs, and maybe that's a way to contextualize it. So, people are often trying to get their tokens listed, right? A lot of great projects out there, and they want to make sure they have good access to exchanges, they have liquidity, there's a good secondary market where people are buying and selling tokens, right? But a big problem for a lot of them is after they launch their token, there's no good source of liquid funds for people to be able to buy and sell. So what we really mean by that is, okay, are maybe the token issuers or another provider essentially making trades that the users can trade against? So are there people putting buy and sell orders out there on the order books that someone coming into the project can go and buy and sell against? Because without that, the books look empty. There's no trade activity, and the trading dies pretty quickly. So we need people to be making those trades, and that's not necessarily an easy thing to do. I mean, a simplistic way to do it is just to put heaps of tokens up at whatever the sale price was, or just to sell and buy at one specific price. But then now you're picking the price, right? So it gets a little bit more complicated. Okay, do we put buys and sells on either side at different prices, different volumes to allow people to buy and sell different amounts? But now you need to start putting in some algorithms to see how you do those sorts of things. So from a development point of view, we encourage the use of automated tools to provide liquidity on the books, right? And it's quite an expensive exercise to do that, because you often have to have the funds to back those trades up.
I see. Thank you for that, Sean. And Tammy, anything you want to add to that?
Yeah, we'll say just a more simplistic view of it is if you were to imagine your token or the marketplace to be like eBay, you just have to make sure that there's enough inventory from whatever you're selling, the widget that you're selling, that it's listed on the marketplace, and there's enough of it to sell to meet the buy demand. And I would add that I think when most people are thinking of doing token sales, a lot of people focus on the pre-sale and what the idea is, but like getting the market making aspect right, the liquidity piece right, will make or break the success of a token sale. And I don't think a lot of people I don't think anyone's like shed as much light of how important it actually is.
Thank you for that. And so how can market making be made to be more of a programmatic thing versus a manual thing? Do you have any thoughts on that?
I mean, internally, we put a lot of resources into making sure that can happen. I mean, a lot of market making happens in places like Excel spreadsheets, for instance, buys and sells through APIs driven by macros there. I think where we're moving to now is seeing a lot of AI and ML, machine learning, come into creating algorithms for market making. So, I mean, in the crypto space, at least, there's, most of the exchanges have APIs that you can access. So anyone can start integrating with those and placing simple buys and sells. Okay. Distributed exchanges we think are really good. So, for instance, Stronghold is built on top of the Stellar distributed exchange, which gives you complete transparency into all of the order books. right? We can tell if something's being manipulated. We can see all of the orders. We know that those orders are real or not, as opposed to centralized exchanges where there possibly could be some places where there are fake sell walls. So, a huge order put at a certain price to deter people from going past it. And there's some cases that people have suggested that maybe exchanges are, or some traders on exchanges can put up fake walls to scare people away or do price manipulation, that sort of thing. So we think distributed exchanges are really good for that, because as a developer or anyone, you can pull all the data down and you know that that's the true state of the network. So that's the access piece. That's not too hard. But then how do you make a bot that makes good decisions on this data? And that's the piece where we start to see a lot more sophistication. And I mean, in the traditional finance world, they have all sorts of algorithms that, based off various things, you might be looking at news sources, or you might just be looking at, previous historic data or price trends and that sort of thing. And people are applying that to crypto quite readily now, but it might not be the most appropriate thing to do, because the markets are they're so small still and very nascent, and they don't react in the same way that maybe the traditional world does. So we see most of the activity is around machine learning and using previous data sets to make decisions at the moment. So at least at Stronghold, we really like to see people with an AM, AI, or ML sort of background to come and help us design market-making bots, because we think that'll be really important, even more so than some of the blockchain skills, to be honest.
Thank you. Tammy, anything you want to add to that?
I will say that, the blockchain is really amazing, because as Sean was suggesting, that, all of the order history, all the execution, all of that is a data set that is, on the blockchain forever, which is kind of a new data set as opposed to the traditional finance world, where you have restricted access, probably for a certain period of time, and you have to pay for it. And with something, for example, like this Stellar's distributed exchange and technology, you can actually get that data and process it for free, and then make those decisions based off of that execution history.
Great, thank you. And so why don't we back up a little bit and talk about the problem that you're trying to solve at Stronghold. So what is it like as an institution these days, if you were to try to institutionalize your usage of crypto, and you were to be buying and selling crypto? What challenges would you have as an institution? Maybe you could talk about how you're addressing some of those challenges at Stronghold.
Well, I will say that the challenges that we have today are not technical. The technical aspects are quite straightforward and fun. I would say that a part of my day, and perhaps Sean's as well, is that I spend probably 80% of my time in regulatory policy. And we try to kind of translate that into code, as well as get financial institutions such as traditional banks or hedge funds to kind of get comfortable with the systems that we have in place.
Thank you. Sean, anything you want to add to that?
I think if I was to give advice to someone looking into doing development on blockchain, just even from a purely technical view, it would be to be very aware and learn some of the basics about the regulatory environment, particularly around KYC, know your customer, identifying customers, record keeping, particularly privacy, with the GDPR and Europe going through. I'm sure we'll see a lot of privacy updates around the world. As we're building these products, it's great to think, how does the blockchain do what I need it to do for the users, but also how do I make sure that what I'm doing will be compliant and future-proofed compliant? Because a lot of these blockchain things, we put them out there and they're hard to change after the fact. Yet the laws will continue to change over time. So we need to be a little bit smarter about how we make sure that we can alter some of the more compliance pieces of what we're building, particularly around storing data and knowing who people are on the networks. So a big part of my day is making sure, from a technical point of view, that Tammy's regulatory policy is enforced, and that trickles down to the individual developer at the end of the day, making sure that they are aware of what it is from a policy point of view needs to be implemented.
And are the regulations even clear today from the government about what can and cannot be done when it comes to cryptocurrencies? I mean, isn't the SEC still kind of dragging their feet on making some of these decisions?
Well, I think it depends on what regulatory framework or body that your institution is regulated from. How many countries how many countries are on this? Like
157 countries.
Yeah, so 157 countries. I would say that some regulatory bodies are actually quite forward thinking and have been very straightforward in what you can and cannot do in regards to cryptocurrencies. And we love to work with those regulatory bodies. And I think there's been others that have been slow to adopt. And they're kind of sitting and waiting and seeing what's going to shake out before they decide how to move forward. But I will say that because we are we do have active dialogues with, for example, the New Zealand regulatory authority called the Financial Markets Authority. They are quite sophisticated, even more sophisticated than your typical blockchain consultant. So I think that it's not that they don't know. I think that they, some regulatory bodies are slow to act.
I see. And so if you're a cryptocurrency project that's considering having an ICO today, does it even make sense to go through an ICO given all the regulation and the nonsense that goes with that? Or should you just do a private sale? Is it too scary these days to do an ICO? What's your guys' view on that?
I think it depends on the entrepreneur, right? It depends on how risk adverse one is, right? And how much work you're willing to put into it. I think that it's difficult. I think ICOs are a great way to raise money, but I think that people don't realize how much work goes into them. Like, you cannot do one successfully without putting at least 6 months, if not 12 months of work into it. So it's not just like, oh, I just raised a $150 million ICO overnight. It never happens like that. It's that the big ones have taken a lot of time and a lot of planning, and a lot of planning and legwork before they've gone on to raise these things.
Sean, any comments on that?
I mean, and a lot of that hard work and time isn't just, founders putting in, sweat and tears. It's a lot of money has gone to service firms for legal and accounting in a lot of cases, right? So, there's roughly people like to throw around, $500,000 as kind of a base level cost for doing one properly.
I think that,
of course, people don't.
I think that was last year. I think now it's probably $1 million US.
It's unbelievable. I mean, the lawyers are basically raking it in these days. I mean, here we are with cryptocurrency and blockchain decentralized without rent-seeking middlemen. And we've got $1,000 an hour lawyers who are actually cleaning up on this whole thing. It's ridiculous. And a lot of it is because the U.S. just hasn't been clear yet on what the regulations are. And so the lawyers are kind of guessing as to what things should be. It's funny, like there was another product I was talking to a couple months ago, and they told me that they hired 5 different law firms, each of whom had partners that got paid $1,000 an hour. And they would ask all 5 law firms the same question. And they would get 5 different answers from 5 different law firms. And they'd have the 5 law firms debate with each other about what the right answer is. And then the result of that debate is what they decided to do with their company, because the regulations just aren't clear yet. So it's kind of an absurd situation right now. And the entrepreneurs and the engineers are suffering as a result of that, because this is coming out of the money that they're raising for their projects, which they need to run their organizations. Because a lot of these blockchain projects don't have a revenue model. They are not intending to make money. They're giving away open source code for free. They're hoping that the tokens will appreciate. But, the capital that they raise, it might seem like a lot of money sometimes, but that needs to last them for a long time. Like, there could be a crypto winter one day where, which could set back their token appreciation for years and years. So they're going to have to make that money last and pay for all their salaries. And so, it's absurd to me that these lawyers are kind of the beneficiaries of this whole scenario here.
This is true.
So
I think we have 7.
You have 7 lawyers. Unbelievable.
7 outside counsels. Yeah.
Wow, crazy.
Yeah.
Let's see here. So we have a couple questions coming in from the audience. Let's go ahead and take some audience questions. And by the way, Tammy or Sean, if you wanted to ask our audience questions, you can do that, and I can type in those questions for them in case you're wondering anything about them. So it looks like there's a couple questions about Stellar. And so to give you guys some context, Stronghold is built on Stellar, and so that is the underlying technology behind Stronghold. So the first question was asked by Luminos, which is, why does Stellar need an on-ramp and an off-ramp? So what is that problem that you're trying to solve in that context?
Stellar is supported by anchors. Anchors are the on and off ramp to the network. That's just the entry. That's the door. So if you had a house, and Stellar was the house, and you needed to enter the house for shelter or leave the house because you needed to go to work, we're the door in and out of the network. So it's vital to to be that door to the network, or else no one would be able to get on the network or get off the network.
Great. Sean, anything you want to add on to that?
Yeah, so anchors are normally trusted parties. You could run an anchor through a smart contract on another network, actually. But essentially it's just it's taking something from the outside external world and representing that as a token inside Stellar. You can't move a house into Stellar, right? You're going to have to trust someone to be holding a land title deed or some claim to the house, and then tokenize that and put that inside Stellar. So the anchors are the custodians that do that. So for instance, we anchor in Bitcoin into Stellar. So Bitcoin, quite slow on the Bitcoin network, but we take custody of that and tokenize that and put it inside Stellar. So now it is accessible from Stellar's internal distributed exchange. So now you can move it and trade it with the 5 seconds Stellar ledger close time instead. When you want to bring it back to Bitcoin, you come back to the anchor, and they essentially dispense the real Bitcoin back to you.
Thank you, Sean. And Sean, while I have you here, we've got another question on Stellar's technology here, which is asked by Sid. So he said, sorry for being blunt, but there's no easy way to ask this. Stellar is 95% centralized, with at least one node that has greater than 50% of the mining power. Given that, I'd like to hear your thoughts on liquidity and thoughts on how you can prevent manipulation and or pumps and dumps. Any thoughts on that?
Okay, so I guess there's consensus versus the distribution of the tokens, right? So Stellar doesn't really have a mining algorithm at all. The tokens were all created up front. I think it was 100 billion by the Stellar Development Foundation back in 2014. It's their mandate to give away at least 95% of those, and 5% is reserved for the foundation. To date, I'm not sure what the numbers are, but they have been making some progress on their mandate to give it away. Whatever the case, Stellar Development Foundation as a non-profit can't just take the money for itself. In terms of validation and consensus, the Stellar Development Foundation nodes are at the core of the network. Or at least they have been until the last few months. It's up to you as an individual or a business joining the Stellar system to choose the validators that you care about. So it's nothing to do with who has the most computers or who's rented out a server farm in China, as with like a proof of work coin. It's all about who do I trust to validate my transactions. In fact, today you can completely ignore Stellar's nodes. This is distinct from Ripple, where there is a slightly different problem, and they are upgrading their consensus to get rid of that problem. But in Stellar, you can now run a Stellar node and be part of the network without trusting Stellar. You can trust IBM's validators. You can trust Stronghold's validators. You can choose how many of those validators to trust and what weighting you give them. So actually, Stellar's consensus mechanism really allows you to a la carte choose who I trust, how much I trust, how many of the validators do I need to be online for network safety. It's really quite customizable. So in terms of that side of manipulation, it's not going to be an issue. For the coins, we just have to see how the distribution model goes.
Great. And we have time for a couple last mini rapid fire questions here before we go. So the questions are, if Stronghold functions as a bank, will you implement fractional reserve banking of deposits? And the second question is, how does Stronghold work behind the scenes, and how does one trade Bitcoin with the Stellar network?
On the fractional reserve question, currently our regulatory, to make sure we're compliant, we have to hold all the funds in bare trust, which means 1-to-1. We can't fractional reserve. We're not an investment bank. All the dollars or the bitcoins or whatever they are behind what we tokenize the network exists somewhere else under custody. So no fractional reserve.
Great. And then on the second half of the question is how does Stronghold work behind the scenes? How does one trade Bitcoin with the Stellar network / protocol?
Yeah, so the Bitcoin introduction on Stellar network happens with that anchoring. So essentially, you need to trust an anchor to bring the Bitcoin in. So Stronghold is one of those anchors. When it's inside the network, it's a native token that can be traded for any of the other tokens, either on the Stronghold platform itself, or you can go to some of the other wallets. Stellar recently announced Stellar X, which will be their kind of premier trading system. But because it's a distributed exchange, decentralized, anyone can access it. And that's true of our tokens as well. So it's free market.
Great, thank you so much. We're just about out of time here. So any parting words before we go, guys?
Yeah, just we're hiring. So if you guys are interested in market making at all in the financial markets, please reach out.
Great, thank you. Well, it's a pleasure having you.
And we're in San Francisco and New Zealand.
San Francisco and New Zealand. Very nice. Wow. So, guys, please check out Stronghold online. The URL is stronghold.co. Is that correct for the URL?
Right.
Great. And learn more there. And I'm sure their job listings are there as well. So thanks again, guys. It was a pleasure having you here today. Appreciate you helping me make a difference for charities here at Hack Summit. And audience, we'll be back in just a minute here with Olaf Carlson Wee, who's the founder and CEO of Polychain Capital. It's $1 billion, the largest hedge fund in crypto in the world. And he's going to talk all about how he invests in cryptocurrencies. So thanks again, guys. And we'll see you soon, audience. Take care.
Bye.
Thanks, everyone.